I want to welcome everyone to our webinar today. This is Ryan Fisher with CamaPlan. Basically, going to turn this over to Brian. He's with Thrive Financial. There's a lot of great information. I've seen this information before. I think it's going to be really helpful to everybody that's on here today. I do believe Brian has some questions that he'll ask you, so I would encourage everybody so that we can get the feedback and the questions answered that are particular to you. When he asks you, there's a chat box that you guys can ask questions or put remarks in, and I'll go ahead and read those for him. So I encourage everybody to be a little more interactive if they have the ability to do that today. So welcome, Brian.
Oh, thank you very much, Ryan. Appreciate it.
I'm going to go ahead and change this over to you. But why don't you give us a little quick background of who you are and why you got into this?
Absolutely. So, yep, like Ryan said, my name's Brian Dougherty. I work with a firm. I'm a financial advisor. I work with a firm called Thrive Financial Services / Thrive Capital Management. And I actually, first of all, before I even get into that, I just want to thank everybody for participating today. I commend anybody who takes a lunchtime break to hop on one of these types of educational type webinars. It certainly says a lot about you. I also want to thank CamaPlan for inviting me to do this today, because it's something that it means a lot to me to be able to get this information out to people. I'm also a member of a non-for-profit called SOFA, the Society for Financial Awareness. Generally, when I go and I do these presentations at various places, libraries, community centers, sometimes even at businesses, I'm representing them more so than my financial advisory firm. So, and I am a member of them. They're nationwide. And then I'm also certified through the National Social Security Advisors Association to do these types of Social Security workshops. But before I get into my story, because obviously I always do, but one of the things I always like to do and put out there, and if anybody would like to respond, I'd appreciate it. I like to ask, what are the reasons why anybody who would attend a presentation like this, why would they, what are the reasons for wanting to maximize their Social Security? And if anybody wants to, join in there and type in their answer on that, and Ryan can read them answers back to me. And the reason I want, I always like
when they come in, Brian, I'll read those to you. But you should also have a screen request to accept your information. I didn't see it up there yet. Your screen.
Oh, okay. Okay.
There we go. Okay.
Did that.
Great.
Okay, so but anyway, and usually on that note, I usually ask that when I'm doing this presentation live, I get, various answers to that. I'll get the answer, I'm just trying to get some general information about Social Security, like, what ages I'm, eligible to do it, what types of benefits, am I eligible for? What's it take to be eligible? That type of thing. What's am I eligible? One of the biggest ones. Am I eligible for an ex-spousal benefit? Can I do a file and suspend claim and this type of thing? So, and one of the common things I get is, oh, I don't want to leave any money on the table, right? So, and obviously there are no wrong answers. It's just they're all valid answers. And sometimes I'll get ones that I don't really even cover in this presentation, like I have questions about disability, that type of thing. And generally the scope of this presentation is really more geared towards uh, really a single or married couple related to their own worker benefits and spousal benefits and survivor benefits that they might be eligible in that relationship. There are tons of other benefits that people could be eligible for, like in terms of when it comes to a survival benefit. There are family benefits that can extend out to adopted grandchildren or handicapped or adopted children, or even parents can be eligible for a claim on their own children if they're dependent for more than 50% or more of their income from them. So, it's certainly vast, the answer to that. But as it comes back to me and why I'm here and what I'm doing and why I decided to really head out and do these workshops, was it really goes back to the beginning about 2.5 years ago. The principals at our firm were talking with SOFA about the potential of going out and doing these types of workshops themselves. And they had decided to do so, and they had scheduled a bunch of them. And they had then posed the question to several of the advisors in the office, is there anybody interested in doing them? So I obviously was curious. I wanted to find out more about it, and got some information. And I'm 51 years old, but I'm remarried, and I have a daughter 30 from a previous marriage. But I have two little guys. Actually, one's going to be 6 in about a month, and the other one's going to be 10 in about 3 months. And at the time, they're 3 and 7, something like that. And it was difficult to get out of the house a couple times a month to go do them. So I said, listen, I'll ask my wife. She also works with me. At the time, she didn't. What her thoughts were on it, and told her all about it. She let me think about it. And then a day or so later, we were talking about it, and she said, I was talking with my mother about it, and explaining to her about what the presentations and the workshops were all about. And she had said to me that she was interested in coming out, her and her stepfather. And I said, really? I said, I wonder, why they're interested. And she said, well, it's funny, but my mother, over the years, when we would talk about her retirement, she would say to me, oh, Rachel, whatever you do, please don't let me eat cat food when I get older. And that struck me funny. I'm like, really? Eat cat food? Why is she worried about eating cat food? She's a nurse. She's been a nurse for 30 years now. That time was 27 years. And she was one of the people who originally had a pension. At about the 20-year mark, they did away with the pension and signed everybody up for 403Bs, which is in the hospital the equivalent to a 401k. She wasn't sure if she was going to have enough money. So she was concerned about it. And when she heard about these workshops that they were doing with Thrive, she said she'd like to come. So I said to my wife, well, let's all go together. And so we all went together. I went to my first one with my in-laws and my wife, just going to see what it was all about myself. We weren't really advising people on Social Security. There was nobody with any certifications. I didn't have any. I had some understanding of it, but nowhere near what it is today. And my in-laws were really, we were all taken by. It was a great presentation. But my in-laws were really, really taken by it, and they ended up deciding to engage the principals at our company to find out more information and whatnot afterwards. Um, and they ended up helping them make some adjustments that just made a world of difference. And my mother-in-law, since that time, has just been so confident about her retirement, which is going to happen this year. Well, actually, beginning of next year, January, the end of January. Um, and you know, she hasn't been talking to my wife about eating cat food anymore, and so that made me feel a lot better. It made my wife feel a lot better. And so after seeing that, we decided that I decided I think this is a good thing. My wife said the same, and she said she even was coming out and she was organizing our desk. She wanted to be part of it. She really believed in it. That all being said, though, and you'll see this once I jump into this presentation, which I'm going to do in about 30 seconds. So as part of the presentation at that time, because it's logical based on all the things that we talk about, the firm and SOFA was always offering this a complimentary Social Security maximization report to everybody who came out to the to the workshop. It really was just a logical progression, because once you see this presentation, your number one question is going to be, well, you know, what's my optimal strategy for taking my benefit? And honestly, we're not able to, I can't, there's like 567 combinations that, depending on the circumstances of any, you know, anyone's circumstance, with the 8 years of eligibility, how much was paid in, what year you were born, what month you were born, it has to do with the mortality tables of the government, all these types of things. So with this report, it's all computerized, and it would allow you, it would give you that optimal strategy to know that you could take into the Social Security office word for word verbatim and tell them that this is the strategy you want to go by. And so we always did that, but as a result of doing these for a while, I really, the one thing I didn't realize at first was that almost everybody was in the same situation as my mother-in-law. They were really interested in the idea of maximizing the benefit, because they wanted to, they really were concerned whether they had enough to retire in their whole retirement plan, and they just thought this would add to it. And so in my practice, my financial advisory practice, I have several reports that I use for my regular clients, using various other softwares that really help give you the peace of mind that well, giving people the peace of mind that my mother-in-law got, that they would have enough. Or if they weren't going to have enough, it would give them the perspective on the adjustments they need to make in order to have enough. So really, I found that was what people were looking for at the very deepest level. And so to make me be able to fulfill my purpose for doing these, which is to be able to give people that peace of mind, I offer everybody not just the Social Security maximization report, which is great within itself to have the right strategy to claim, but it doesn't. It's really more in a vacuum. It doesn't really it doesn't really solve the underlying concern, and I wanted to solve the underlying concern. So at the end of this, if anybody's interested in any of those reports, I'm going to show you my email. You'll have my direct work line, so you can get me to call me. I'd be happy to provide them for you. Generally, what I do, though, is for people who do these workshops, I check out every week in my calendar. I reserve spots for people to do these because they're kind of part of my SOFA membership commitment to do that. People come out, I review these complimentary reports for them, give them to them, and hopefully that'll give them the peace of mind they're looking for. So at the end of this, you'll see my name you'll have my name, my number, my email address, everything you need to contact. So that all being said, let's jump in a little bit, and if there was any
While you're jumping in there, Brian, I was going to comment a little while ago, but and these are common things you hear. They want to be able to have the best possible lifestyle in retirement, and then another was, and I know you'll get to some of this stuff. I'm a 62-year-old widow looking for information on when to apply for Social Security, and also have a son in college. And I know you'll get to some of those different kind of topics, but I'll let you keep going.
Well, okay, so yeah, they hit right along with a lot of the general ones I get. They're all obviously legitimate in of themselves. There's a plethora of information that people about Social Security and the various election choices and eligibility as it relates to each that we will hit on. But if what we hit on isn't specific to what your question is, folks, then please, you'll have my email. Send me the email. If you want to put a contact number in or whatever, I'd be happy to do that. I can tell you this: a lot of the answers related to getting more out of the Social Security system, increasing your benefit over your life expectancy, really come in having that Social Security maximization report, because it has the ability to obviously compute all of the different variables, which would be custom to each person. And I think and we'll know it when we address whatever your question is, but I think quite a few people will that will solve the problem in and of itself. So that being said, is it a good time to jump into this now, Ryan?
Yeah, go ahead and jump in.
Okay, so all right, well,
just get them the information they want.
All right, so let me just see if I can all right, make sure
in the bottom left-hand corner you should be able to hit an arrow.
Yeah, no, and I'm just trying to, for some reason I
saw it change there for a second.
I got it to change. I just my clicker is kind of going weird on me. But hold on, let me just try something. All right, so I'm just going to go with this method. So anyway, here's some of the topics we're going to go over. Basic ones: understanding your monthly benefits, managing the impact of taxes as it relates to your benefit, working in retirement as it relates to your benefit, Social Security and past marriages. Past marriages is a big one because you got about 50% of the marriages out there end in divorce. So there's a lot of people out there eligible for ex-spousal benefits. So we get a lot about that. Protecting the surviving spouse. That's one that we always go a little deeper with, because it's become a major issue when it comes to people in retirement. You do lose one of your benefits. You get the higher of the two benefits when one spouse predeceases the other. So there's definitely a lot to talk about with that. And Medicare, really just touch on a couple things with that. Strategies to maximize the lifetime benefit, filling the retirement income gap with Social Security, or helping to. and obviously putting all these puzzle pieces together. So that all being said, there was a survey done 2011, couples 60 to 66, asking, can the Social Security Administration provide the advice you need? They found that 77% of the folks out there thought that they expected that they would. And this is actually a memo, internal memo that went out to the claims authorization staff at Social Security. And if you see here, right here on number D, it says, provide enough information so that claimants can make informed choices, but do not give advice. So now, obviously there's various reasons for that. One of the things obviously is, well, the number one thing is liability, but also too, it's no secret that the administration and the plan has been under stress for many, many, many years for various, reasons, and that they're always trying to conserve on it. So this is, one of the main reasons why our firm got into doing these, because we knew that a lot of people were looking for information about it. Just a little background information on myself: 20 years business and financial services experience. I am an investment advisor represented in IAR, which means I am a fiduciary. And if you don't know what that is, basically a fiduciary has to put their clients' needs above their own at all times, and they're legally bound to that. I also am a certificate holder with the National Social Security Advisors, and I also am insurance licensed. So understanding your monthly benefit. So starting out, I usually tell people this. So I'm going to go through some very basic things to start out with. So it may seem ridiculous, but I find there's some nuances in them that people really need to understand. And then I'm going to go and I'm going to get into some strategies and some, things a little deeper. And then I'm going to give you some really serious food for thought to kind of motivate people, because the truth is, and this happens to all of us, life gets in the way of the biggest, most important things in our life, and obviously our retirement's one of them. But putting together a strategy to maximize your Social Security is a big part of that, and we find that people start out, wow, I want to do this, and then they start to fizzle out over time because life's getting in the way. So I'd like to give a lot of food for thought on that to give some motivation. Anyway, we're starting with the PIA, and basically that's an acronym you hear in all the Social Security on the website and the pamphlets they hand out over and over and over again. It's called the primary insurance amount, and that's a lot of people think that that's the benefit amount that you get, and it's true. It's related to it, but there are three things that you need to know that are most important. One, you need to know how they come up with it, or how they determine what your benefit amount is. And that's based on your highest 35 years of earnings. And it is adjusted for insurance, or indexed, they call it. Two, I think is very important, although it's not on here, is you must know that your PIA is associated directly with your full retirement age, or what they call your FRA, which I'm going to show you in a minute how you determine that. So your PIA is not necessarily an amount. It does have an amount associated with it, but it's a reference point. So they say that, okay, so your PIA is the amount you're going to get at your full retirement age, okay? So if you don't take your benefit at your full retirement age, you're not receiving your PIA. You're receiving a percentage of your PIA, and that could be a reduced percentage or an increased percentage. So that's an important thing to understand, because when you see it in the literature, you start to notice that it's being used as a reference point, and people don't necessarily pick up on that. So I like to really make sure and drive that point home. And the third thing, and probably most basic thing about it, is where do you find your PIA? So you can see here, you can get it on the on their website, ssa.gov. You sign up. The other thing too is you can get it right on those statements. I don't know if anybody still gets those. Is still getting the green statements. There's definitely been some confusion when it comes to them. Obviously, we used to get them every year, up to everybody did up to 2011, and then they stopped for 2 years. They came back in 2013 over a lot of frustration that went on with people not getting them. But they now came back in a modified fashion. They start when you're 25 years old, you get your first one, and then you get them every 5 years until you're 60 years old, and then you get them every year until you're 70. Okay, and so, but what you must know is if you do go to ssa.gov and you sign up, it's just like the banks do these days. If you sign up online, you go paperless, so to say. And now you won't get the green statements anymore. So if you do want to still keep getting them, then you stay away from signing up online. Although I want to tell you, if you sign up online, you'll get updated information all the time. If your PIA changes, it will change. If you're paying more in, I advise you to sign up online. I think it'll be better for you in the end. But anyway, that being said, let's talk about your full retirement age. So your FRA. So originally it was the age 65 for everybody. Then again, with stress on the system, the administration decided, or the government decided to start to push it back to age 67, but they didn't want to do it overnight, so they created this scale for gradually doing it, and basically lays out like this: if you were born 1937 or earlier, it's still 65. 1938 to 1942, it increases by 2 months. So it's 65 and 2 months, up to 65 and 10 months. Now, anybody who was born between 1943 and 1954, it's 66. And that's what the vast majority of people who are taking claims now are. Somewhere around 1952, 1950, around there, the people I see the vast majority of, 50 to 57, 58. Right now. So anyway, then if you were born 55 through 59, they added another 2 months, and then if it's 1960 or later, like myself, born in 1967, it's 67 years old. So now, just so you know, this presentation is based on a person's full retirement age being 66 years old. If you change the full retirement age to 66 and 2 months, even, all the numbers I'm going to show you will be different. Okay, so you can't go off this as being associated towards you if it's, or specifically to you if your full retirement age is not 66. So here's a question I always ask people is, what's the earliest age you can take a benefit? It's age 62. And what happens if that benefit, if you take it at age 62? It's actually reduced by 25%. So if you take it at 62 and your full retirement age is 66, remember I said this presentation is based on it being 66, you'll have a 25% reduction in your benefit. So you'll be getting 75% of your PIA, your primary insurance amount. Now, mind you, anybody who's full retirement age is after 66, you're actually going to get reduced more than 25%. In fact, if your full retirement age is 67 and you take it at 62, you're going to get a 30% reduction. You're only going to get 70% of your PIA. So just to keep that in mind. And so every year thereafter, obviously it increases. And in this particular case, for this presentation's purpose, you would be getting 100% of your benefit if your full retirement age is 66. And I ask people, what's the latest age you can take your benefit? And most know that it's 70 years old. You could take it after, but it's not going to grow anymore. Okay, it stops growing at 70. And what percentage of growth do you get if you leave it in past your full retirement age? Well, it's about 8% a year if your full retirement age is 66. If it's older than 66, it's a little less than 8% a year. So it depends on when your full retirement age is. But you can have as much as a 32% increase, almost a third of your benefit if you can wait to 70. Obviously, there's a lot of reasons why people don't wait. Financial constraints are probably the biggest one. But a lot of people don't realize that if they understood timing out their benefit correctly, or if there was other strategies that were available to them, they could end up maybe being able to wait a little longer if they had the right strategy. So that's some of the stuff we talk with people about, and the Social Security report helps people get advise them on. So the next thing we talk about, and obviously, if anybody's there and they have questions, put them in the box. We'll try to address them at the end. But if you have a piece of paper handy, you want to write those questions down. If you are interested in coming in and getting that Social Security maximization report from me, I can address those questions in more depth there. So whether it's finding your PIA, sometimes I help people if they come in the office actually get on the website and find it for them, get them signed up. It can be a little tricky with the questions and whatnot. You actually got to be careful because you can get locked out of the system fairly easily. So I'll help people do that. You can write that down, let me know, can do that. And also trying to time out as far as the percentages. What are the percentages that apply to your full retirement age? Any of those questions, write them down. I'd be happy to answer them. So let's talk about past marriages with Social Security. So yes, if you're in a divorce situation, you might be eligible for a benefit on your ex-spouse's work record. A few things have to be in place in order to do so. One, you have to be married for 10 consecutive years or longer. Two, I will say on that note, if you are divorced and then within that period of time and remarried within the same year, you still would be considered married for 10 consecutive years. Okay, so that's an important one. Another thing I tell people is if you got separated, say 8 years into a marriage, but the divorce decree didn't come in until after the 10 years, you're eligible. Okay, so you just got to look on your divorce decree. The other thing is if you're 62 you have to be at least 62 or older. But if you are younger than your full retirement age, it will be a reduced benefit that you get. You have to be unmarried, but your ex-spouse can be remarried. Okay, that doesn't matter. However, your ex-spouse has to be at least 62 years old. So there are the four things that have to be in place. One last thing that's very important though, if your ex-spouse is eligible for benefits, you have to be divorced at least 2 years to be considered independent of your ex-spouse. And what that means is, um, if so in a marital situation, in order to get a spousal benefit, the person with the worker benefit you're claiming that spousal benefit off of has to take a claim before you can be eligible. We call that open up the window. So if they open up the window, then you can go in and take your spousal. If you're divorced, but it's not for 2 years, at least 2 years, you're still in the same boat. Your ex-spouse has to file before you do in order for you to be able to get that ex-spousal benefit. After the 2-year period, you're considered independent, and it doesn't matter if the ex-spouse files for a benefit or not. You can still file for your ex-spousal benefit. So that's an important thing to understand. Some people think they're slick. They're going to get a quick divorce, and what's it matter? It's only a piece of paper, and then we'll just go get the benefit, not realizing they got to be divorced for 2 years. So it's not a quickie. So anybody has questions about past matters they might be in, write it down. If you're going to come into the office, we can talk about it. I do get a lot of ones about that. There's been times I've actually had to research them with the people that I actually had the certification through. But I will take that deep dive for you. Understanding your lifetime benefit. So basically, what if you knew, okay, that the 3 ages most associated with Social Security at the moment, 62, 66, and 70, for the people who are full retirement age or 70, okay, if you took your benefit on all 3 at any one of those points, in nearly every circumstance, you would not get the maximum benefit, lifetime benefit. So normally I ask people that question at a workshop. I say, how many people are a little surprised at that? We usually get 30–40% of the hands go up, and especially because they think that if they wait till 70, they're going to get the most out. And the reason that is because of life expectancy. Government actually hopes that you take your benefit at age 70, because based on this chart, you'll see that if a person took their benefit at 62, 66, or 70, this chart is based on a single person average size claim. Okay. Now, unfortunately, we don't know the year and month they were born. Well, we know their full retirement age is 66, but we don't have the specifics enough to know that they're what the life mortality tables are going to be for them specifically, because there's a lot of people that fall into the 66 range. So, but in this case, this is showing that this person, if they took their benefit at 62, see a little space there, actually is getting a teeny bit more out of the system than the person that took it at 70. It's actually a little below the space at the 415,000 mark. Now, obviously, if you took it at 66, you'd get more, but you can see that it's not the maximum amount. And so based on this chart, 67 and 2 months for a person, a single person, at the average benefit amount comes in around 66 and 2 months. Now, this is, again, it changes depending on the year and month you were born, because the mortality tables change. But this is because of their life expectancy. And if it's a couple, you kind of superimpose this chart over top of each other, and it changes the individual's recommendation to be able to actually provide more to as a team, so to say. So most people are a little surprised by that. I tell people, look, if you want to find out that sweet spot for you, the only way that I can do it is through the report. I don't have the capability of figuring it out on my own, especially when it comes to a couple and whatnot. But I have no way of applying the the mortality tables to the situation. But at least you have a perspective on knowing here that there is a sweet spot based on life expectancy where you can get a maximum amount from the benefit if you from the system if you can figure it out. So anybody, like I said, who's interested in finding out more about that, just put that in an email to, and let me know that we can talk about that. Or bring that with you in your list of questions, and we'll talk about that. So
Just jump in real quick there, Brian. I was just
sure.
going to grab a few questions there. What's the life expectancy used by Social Security for women?
That's a great question. Generally, from all that I have seen, it has women outliving men by 2 years. Okay, and up till last year, the average ages were 80 or 3 years, 82 for a male and 85 for a female. It was 3 years at that point. Now this new, the last bit of update I got on that, it took a major jump. Has men live until about 85 on average and women till about 87. So it is longer for women, absolutely, which poses a problem in the sense that, and we'll talk about that with the survivor spouse situation in a few minutes, but it poses a little bit of an issue because it has women outliving their husbands a good deal of the time, and so life expectancy can really, as it's increasing, can really throw a monkey wrench in if you're not planning around it. Any other questions or?
No, not at the moment.
Okay, so then talk about the strategies to maximize your lifetime benefit. So now we're getting a little more into the more interesting stuff. First of all, a little food for thought. First of all, a married couple, if they just try to do a simple break-even analysis where they're saying, oh, I'm going to get this much, this year. If I put it off to then, I'm going to decrease the amount, and I subtract it from what I would have got, and there's the difference. It usually is wrong because it doesn't take in account the multiple benefits that a person that they offer. I do disclaim this, and the strategies that can be taken as a result of it. Well, it says Social Security offers multiple benefits and strategies. They do offer obviously multiple benefit election choices, but they don't offer you the strategies. You got to figure that out for yourself. And so it's difficult when you throw in life expectancy into the mix. It now break even. You really don't know what break even is then. So I often remind people of that. So obviously the first election choice is your worker benefit. This is the original benefit. Like I said, originally it's based on your 35 highest years of earnings, and it is indexed for inflation as well. The next one is your spousal benefit. Now, first of all, I want to just say this right out of the gate, just to make sure, because I've run across cases like this. The spousal benefit is a separate entitlement benefit. Okay, it does not, especially in a divorce situation, it does not affect the worker's benefit at all. You do not have to get permission from the worker. It is an obligation of the plan to pay that to you if you qualify. It is a separate benefit. My mother had no worker benefit to speak of. She was a homemaker for most of her life, didn't pay enough in. She collected a spousal benefit. A spousal benefit is generally, if you wait to your full retirement age, 50% of whatever the worker benefit is. But again, if you do take it prior to your full retirement age, it will be reduced, and it's reduced at a greater rate than the worker benefit is. Okay, so keep that in mind. Now, survivorship benefits. So now, obviously, when it comes to survivorship benefits, you could go volumes on it when you start opening it up to the idea of family benefits, bringing in anyone other than a spouse involved. You'd be surprised what you can actually what we can actually do. One thing I ask people generally at these workshops is how many times do you think you could be married for 10 years in a lifetime? What do you think the maximum amount of times a person can get married? 10 years. You know, and it usually gets a little giggle, and people say, oh, well, it could be, you know, depend if you started at getting at 18 years old, and could be 4 or 5 times. Well, when it comes to spousal and survivor benefits, an ex-spouse can literally leapfrog from one spouse, ex-spouse, to the next benefit until they get to the highest spousal benefit. And if that spouse predeceases them, they will get 100% of that person's benefit for the rest of their life. If that person has 5 ex-spouses, they're all going to get it. So gives you perspective on what survivor and spousal benefits can actually go. But the most important thing to know in the survival benefit for the context of this presentation is that the survivor will get the higher of in a relationship, in a marital relationship, will get the higher of the 2 benefits. So if the worker's getting, you know, $2,500 a month, and the spouse is getting $1,250, then the $1,250 will go away when the worker passes, and the spouse will now get $2,500. Okay, and that works the same in a divorce situation, in a past marriage, ex-spousal benefit. So the other is one. There's still one out there called file and suspend, but it was stripped of all its really effect when the through the impact of the bipartisan Budget Act of 2015. So I'm not going to really get into it. It's completely benign at this time. There is still, though, one other related eligibility election choice, and that's called a restricted application. In order to be eligible for a restricted application, you have to have been 62 by January 1st, 2016. If you were 62 after that point, you're not eligible. If you were 62 prior to that point, you are eligible. And although because of those rules, it is going to grandfather out, eventually no one who's eligible will no one will be eligible anymore based on time passing. But if you are, this is how it works. So one, there has to be a worker benefit that's already taken in the relationship. So one person has to open the window and take their worker benefit. After that happens, the other person, if they qualify and they were 62 on or before January 1st, 2016, they would say, okay, I want to file, but I don't want my worker benefit. I want to take my spousal benefit, and I want to leave my worker benefit in the system to keep collecting what they call delayed retirement credits. And that's that 8% that we're talking about if your full retirement age is 66. And you can do that all the way up to age 70. Okay. This is still eligible for folks that qualify. So now there are some people that are dually eligible. There are some circumstances multiply eligible. Okay, depending on when you were born or when you were 62. So really figuring out how to combine those different eligibilities and time them out at different times can make a substantial difference to your benefit. So jumping past that, always ask people how are they going to claim. Most people don't know. And again, that's why I said that it was the logical conclusion for us to offer people the maximization report so they can have that for themselves.
Let me just jump in right there real quick and ask you another question there, Brian. Is the spousal benefit only for a spouse that did not work?
No, not at all. Spousal benefit is for any and all spouses. Whether it makes sense to take advantage of it depends on how much you paid in. Sometimes you get a situation where a person's worker benefit is less than the spousal benefit. So in that case there, it makes sense to take the spousal benefit. And again, it depends on the circumstance involved with people, because some instances the higher earning a spouse can be younger than the lower earner, and say they don't reach 62, or they're not going to reach 62 before the other. So when the older one makes it to and possibly lower earning one reaches it to 62, they're not eligible for a spousal at that time. The only thing they can do is take their own worker benefit if they have it. Okay? Because you can't take a spousal benefit unless you're divorced for more than 2 years without the higher earner or the other spouse. And you would only take it if it was a higher earner, because then your worker benefit would be higher. The higher earner needs to take their claim. So in that instance there, you would have to take your survivor your own worker benefit and wait till they turn 62 and filed, right? That for you to be eligible. So it does get a little tricky like that. And when the ages flip-flop, depending on who made the most, that's why this report really becomes so integral in what we offer people, because those types of scenarios can really get it to be difficult to figure out. Any other questions?
Let me check there. So the worker benefit has to be taken if somebody's waiting until age 70 to take it. The spouse can't get the spousal benefit till the other spouse starts taking.
Correct. Yep.
Okay.
Correct. They would have to take their own worker benefit if they have one.
Okay. Got it.
One thing what everybody should know too. So the worker benefit will grow to age 70, but the spousal benefit stops growing at full retirement age. So, and here's another tidbit. So if you were to take a spousal benefit at your full retirement age, but your spouse took their benefit at a reduced age, you would not be getting 50% of their reduced benefit. You get 50% of what their full retirement age benefit would have been. And it's the same thing if that spouse waits past their full retirement age and gets a higher benefit. You won't get half of their increased benefit. You'll get half if you waited to your full retirement age of what their full retirement benefit is at your age. at your full retirement age. I know it gets, you see how it gets a little confusing?
Yeah, and let me just throw a few more out there to you. Does the spousal benefit stop growing at full retirement age if the major wage earner is deceased?
Well, if the major wage earner is deceased, it's actually, they actually do a special formula depending on what age they passed away. If they passed away before their eligibility, then you actually have to have them do a special formula for you on what the benefit amount is. But if they pass away uh, uh, prior or after their full retirement age, then you would get their full worker benefit, 100% of it, because you're getting the higher of the two. As long as it's higher than your worker benefit, okay, you would get their. If you don't have a worker benefit and you're getting a spousal, then you're just going to get you're going to lose your spousal, and you're going to get their worker benefit at whatever age you are.
And let me just ask these two at the same time because they're kind of related from two different people, though. What is the maximum benefit at age 66 if you paid the max for 35 years? In other words, what is the max that is paid out on a monthly basis? And then the other question was, are there any caps on the amount of any of the benefits you can receive?
So, well, yeah, I mean, the max obviously is the cap. So if you're paying FICA, right now FICA is about $127,200. And and so, but even if you paid that in, they still cap you out at a certain max. As of 2018, the max benefit is $2,788. Okay, so you paid in the FICA on up to the max. That's the highest you can get. Now I know there are some people they will allow certain types of employment will get credited into it, because I've seen people with higher than 2788 and whatnot, but there's special situations. The normal situation, the max benefit's 2788, and so that's a cap in a sense, unless you wait past your full retirement age and get the delayed retirement credits for the increase.
That's it for now. Carry on.
Okay, so let's talk about protecting the surviving spouse. So just going to give you, this is where I start getting into some food for thought. More than half of elderly widows that are currently living in poverty were not poor before the death of their husbands. And more than 70% of all elderly persons with incomes below the poverty line are women. This really hits home for me because this happened to my grandmother. She actually predeceased my grandfather by 21 years. He died at 70 or 71, and she died just about 3 weeks from her 92nd birthday. So I actually saw this happen. At the time, I didn't realize all the percentages and whatnot. I was a much younger guy, but it really hit home. So this is the reason why we kind of always talk about this with people when they come in and talk with us, because this is some important stuff, and you can do some things by maximizing your benefit that can help mitigate this situation, and we always like people to know that. Also, for a 65-year-old couple, longevity playing into it, especially for women. If they make it to 65 together, there's a 72% chance one will live to 85, 45% chance one lives to 90, and an 18% chance one lives to 95. I recently saw a study from over in Europe saying if you were born after 2000, there's a 50% chance everybody born after 2000 in America is going to live to 104 years old. So longevity is really playing a big part of you know, what people need to plan for their Social Security and for retirement in general. Just here's a scenario that we do see at our office. Just fictitious, you know, we call him George and Mary Bailey. George had a pension of a little over 14,000. Mary's was at 6. His Social Security was a little over 30, and Mary's was a little under 8. Their retirement income being a little over $58,000. And so talk about their assets a little bit. We'll get back to this in a minute, but they were pretty good savers. They had about 400,000 in investment CDs and savings, and about 25,000 in death benefit each, leaving each of them 425,000 in this instance. But I'm going to get back to this in a minute to talk about this more. But in this scenario, and by statistically George predeceases Mary, what ends up happening? In this case here, and we see this more than we would like, George had a single payer option on his pension, left Mary with no pension of his, just her own pension. As a result, thank goodness she's getting the higher of the two Social Securities. So she gets George's Social Security. The end of the day, though, she ends up taking almost a 40% reduction in her income. This is exactly what happened to my grandmother. A lot of it was because my grandfather didn't even have a pension. So that was, and right now, these days, at one point in time, of the private sector, 30% of the people had pensions. It's down to 3% now. So this is a big deal. Obviously, a lot of people say that this is a concern. This is a big concern of ours too. And so we talk a little bit about some strategies for doing that, and maximizing the benefit is a big part of it. So let's talk about taxes. I know most people hate tax time. And yes, Social Security is taxable in some situations. Let's look at it because as much as 85% of it can actually be taxable. And these are the different income sources that are taken into consideration with the formula that's used. It can be even tax-exempt interest, but wages, pensions, dividends, capital gains, business income. But the real surprising one is even tax-exempt interest. It's tax-exempt, the actual investment. Usually it's municipal bonds or something like that. But the actual interest amount is used for the formula when they're trying to decide how much of your benefit they're going to make taxable. So it's based on something called your provisional income. This is the formula for it. They take about 50% of your benefit. So say that's your benefit's $2,000 a month. So they take $1,000. You add your ordinary income, which could be like rental income, could be IRA income, anything like that. Dividends and capital gains are separate. They get taxed differently, but if they do take that income into consideration, they add that to it too. And then, like I said, that non-taxable interest, that's also added to it. And this is kind of how it plays out. So if that number, when you add all these up, if the number is below $32,000, then none of your benefit is taxable. Okay. If it's between 32 and 44,000, then 50% of your benefit's taxable. And if it's above 44,000, then 85% of your benefit's taxable. The one thing I do say to people, and of course, obviously, having 0% of your benefit taxable is great, but having an income of 32,000 or less is not so great, and that's what most people tell us at the workshops. But the truth is, though, that if a person acts early enough, there are some sources of income that aren't counted for the provisional income. If you set yourself up correctly, with your investments. And you could actually just be showing 32,000 in income, but have more than that, and then be paying a 0 or 50% of your benefit being taxable, reducing your tax, considerably. So that's kind of something that when people come in, when I'm doing them reports, especially when I do the tax forwarding report, I kind of look at that kind of stuff for people too. Again, if you have questions about that, is there any questions out there that you want to address now, Ryan? Hello?
No, I didn't see any there. Sorry, I hit mute.
Okay. No problem.
We're okay at the moment.
Okay, but if you do have questions, write it on a piece of paper, or send it in an email. I'll be happy to address it. So now, working in retirement. So this is a lot of people are planning on working in retirement. It's not just because they have to, it's because they don't want to spend 7 days a week in the house. My own father-in-law is 68. He already has it prearranged with his employer. He's been with over 40 years, that he's going to work 2 days a week with them. Okay, AARP said that based on their estimates, about 80% of baby boomers plan on working to some degree in retirement. The important thing about this is this. You have to find out what effect it's going to have on your net income, because there is a penalty system when it comes to how much income you can make while you're collecting Social Security prior to your full retirement age. So, and then depending on what your age is, you can actually get penalized 100% of what your benefit is. Okay, so let's talk about that a little bit. So it's based on two different sets of rules. It's based on the lower threshold rule, which is basically a time frame. It's in this instance, if you were going to be your full retirement age in 2017, right here, then in the beginning of the last quarter of 2013 to the very beginning, first day before the first day of 2016, during that period of time, you're subject to what they call the lower threshold rule. Now, the higher threshold rule is during that year you're going to be your full retirement age, which is right here. Okay. Now, after your full retirement age, there's no penalties anymore. You can knock yourself out. You can make as much as you want. This is how it works, though. Based on 2018 rules, that threshold for the lower threshold, that earnings threshold is $17,040 a year. And for every $2 you make over that amount, the government the following year is going to hold back one of those dollars. So for instance, if you made $60,000, you would have been $42,960 over the threshold. And in essence, since they're taking one out of every two, the following year they're going to hold back half of that from your benefit. So if you were getting $2,000 a month, what happens is they stop the checks. They stop coming. And they don't go by exact amounts. They go by checks. So if you're getting $2,000 a month, the first 11 months of the following year, which would be all the way up through November, they would hold back every one of those checks. $22,000 would be held back. So you would get one check that following year for $2,000 in December. That's how it works. And now,
these might be. Oh, sorry. No, keep going.
No problem. So the higher threshold is at the moment $45,360, and for every $3 you earn over that amount during that time period, again, this happens in the year you're going to turn your full retirement age. So that's what you would get $1 out of every three made over it, taken back from you the following year. So how would that play out? If you make that same $60,000, that being the threshold, now you're only $14,640 over the threshold. and they're going to hold back 1/3 of that, which is $4,880 the following year. Now, what you need to know is that they do return this money back to you after you turn your full retirement age, but you don't get it in a lump sum. They stretch it out over what they consider to be your life expectancy. However many checks you're going to get from your full retirement age to your life expectancy. If you don't make it to your life expectancy age, then your spouse, if you predecease them, will get paid it until they make it to your life expectancy age. If they don't make it to your life expectancy age, then your family just doesn't get it. You lose it. So you want to be really careful if you're going to take your benefit prior to your full retirement age. You want to find out about these. There are also rules, by the way. If you're going to retire in the middle of the year, the first 6 months of that year, just in the first year that you retire, do not apply. They go on a monthly basis. Okay, so anybody who's trying to find out, and I do get quite a few questions about this, more about it, we can certainly go over that and we can figure it out for you depending on what the circumstance is. If you want to send me that email or come in to the office. We're going to talk about Medicare just for a little bit, not a lot. Obviously, if you Google Medicare, based on all the changes over the years, it's the volumes and volumes have been written about it. But for the intents and purposes of this presentation, we think the most important thing is how much you're going to spend, nearly $300,000 on Medicare in the first 20 years of retirement. And so this is based on a married couple that makes it together to age 65. Obviously, you apply for Medicare at age 65. You have a 7-month window, 3 months before the month you turn 65 and 3 months after. If you miss that window, you're going to be subject to a 10% penalty for life. And for every year that you miss the window, they add another 10% to it. Okay, so I advise everybody, get in there and start first month of those first 3 months. Even if you're still working, because they like people to be on Medicare Part A, which I use the word free loosely, but we all know everybody paid for it. Comes with the benefit. There's no charge. But using an average increase, inflation for the Medicare at a roughly 5.8%, and it's been higher than that lately. A couple of years ago, it was a 17% increase. That couple over the first 20 years, just paying for their Medicare Part B, which is the amount that gets deducted from your benefit before it gets deposited into your account. Over that first 20 years, they're going to spend close to $116,000 just on Part B. And on the prescription plan, which is Part D, they're going to spend between $34,000 and $35,000. And the killer is the supplement, because Medicare only pays for 80% of your health expenses. Yeah, I highly advise everybody to make sure they get a good supplement plan. They average around $175, $180 a month. Over that lifetime or that 20 years, that couple's going to spend almost $130,000 on just a supplement. That's a total of almost $280,000, and it does not include any co-pays, out-of-pocket expenses, or costs for treating uncovered conditions. With all that in, which is roughly the last study I saw, it's about $1,175 a month a year per person. It's going to be upwards of $300,000. But I always tell people, as you remember, talking about the Baileys, George and Mary, how many people think that George and Mary thought they were going to spend $300,000 of their $400,000 savings on health care? Most people how many people think that they didn't think it? Most people would raise their hand at our workshops. So this is good food for thought. Kind of drove that home. At this point, gave you about as much food for thought as possible when it comes to motivating, I think, people to really carry forth the plan to maximize their benefit. Now I'm going to talk about quickly about how Social Security plays into filling an income gap, and then I'll get a little bit into those other reports that I offer people to try to give them the peace of mind that they're looking for when it comes in general, like my mother-in-law was really trying to look for. So let's jump into this. People come into the office. It's a simple formula for seeing if there's a gap in their income. You take their Social Security income. If there is a pension, you add it to that. And then you add it to what the potential investment income is. That's a little more complicated. You basically got to take the total amount of the investments plus whatever potential return it can get, and then divide it by the number of years of up to life expectancy. And then you subtract people's expenses from that. If that number is a negative number, then there's a gap, and we say it. So we know that person's a good candidate for trying to maximize their benefit. So let's talk about that, what the effects are, and we've seen this. So this is based on the same couple in scenario A. In scenario A, they don't maximize their benefit or optimize it. In scenario B, they do. Okay. They have a need of 100,000 in income. They're starting out with about 600,000 in assets for this intents and purpose. So in this scenario, they don't. The higher earners making a little over 31,000. The lower is at 20, a little in between 26, 27,000. With a need for $100,000, they're going to need to pull a little over $42,000 a year out of their retirement savings to fill that gap. Okay. Now, if they do that, okay, this is what's going to happen. Calling it the IRA, could be 401k. It's some type of retirement plan, right? Obviously, by the value going down, the growth potential of that 42,000 every year reduces with it. Okay? Over the first 20 years of the retirement, just based on that, they lose $307,585 in this situation. On top of that, they have to pay additional taxes. They have to pay taxes on this money, okay, at 100% rate based on their effective marginal tax rate. In this situation, it's almost 43,000. The total reduction in their retirement savings is over $350,000. Okay, additional reduction at that point. This scenario A couple, or this scenario A actually leaves the people almost broke. But in this situation, having optimized the benefit, the higher earners getting a little over like 12,000 or so more than they were getting. As a result, then now the lower earners staying the same, but as a result, now they're only pulling out a little over 29,000 of the retirement savings. At the end of that 20th year, they still got $300,000 in their savings. So that's how much of a difference it can make if it's for some people when they optimize the strategy. Even if it isn't this extreme, it's going to have impact on the circumstance. And so giving you some food for thought on helping to fill the gap, that income gap using Social Security. So now, always tell people that Social Security planning is just part of retirement planning. 3 good reasons for that is one, The average household, Social Security is making up close to 65% of their income. Two, the difference between the best and the worst decision in terms of optimizing or not, and I'm going to show you a more extreme circumstance than even this. It can be between 30 and 170,000. I actually have instances that I've ran into that were between 18,000 and 181,000 additional income coming in. And then we say it's the Social Security is the best annuity money can buy for a couple of reasons. One, it's called a unilateral contract because most people pay in less than what they get out. Okay, and if you compare it to any other type of annuity that exists out there, you pay less in and get more out of Social Security than any other annuity that exists. The other thing is, for every dollar more that you get from Social Security is going to be one less dollar, like I just showed you, you're going to use of your retirement savings. So it kind of like adds to your retirement income. So it becomes annuity in of itself in that way. So big reasons why Social Security is an important part of the income, the retirement plan. Sewing this thing up, before I get into talking about a little bit about the additional reports that I offer people to try to really get to the core of their concerns and solve that issue. This article written in the Harvard Business Review in 2014, July and August edition 2014, really got to the heart of it. We really, our principals of our firm revamped their entire mission of the firm off of a lot of the things that were talked about in this article. And obviously the title of it, The Crisis in Retirement Planning, our approach to saving is all wrong. We need to think about monthly income, not net worth. At the end of the day, in a nutshell, and I highly recommend, I have a bunch of these in my office. I'm not allowed to give them out in our live workshops anymore. Something has to do with copyrights, but I can give them out in a personal meeting. The gist of it is this: with the pensions reducing down so drastically over the last 30, 40 years, and they're defined benefit plans, that's what they're called, and the industry going over to defined contribution plans, which are 401ks and IRAs and 403bs. Now people, and it's just starting to come to a head now, because a lot of the people are retiring that this started with 30, 40 years ago. Now they're at a crisis where they don't know how to turn these assets into income. And they're really struggling to do it. And that's what their research was done, and that's what it's all about. And that gets to the heart of like what my mother-in-law being switched from the pension over to a 403b about 2/3 of the way through. She was concerned about it. She didn't know how much she was going to be able to draw on from it and how long it would last. So that's what this article is all about. And so the reports that I hand people out helps them have a perspective on that can give them peace of mind. And so you have to understand a couple of concepts before you can understand the premise of the reports. One, very simple first premise, just understanding the difference between your accumulation phase and your income phase when it comes to investing in general. So, but obviously it's kind of self-explanatory. When you're in your your accumulation phase, you're working. You're getting a salary or some type of paycheck. At the end of the day, you're subtracting out your expenses and you're saving the difference. Really, most people these days with 401ks are saving before they're even getting their pay and paying their expenses. But at the end of the day, the net result is they're only going to save as much as they can afford. because they still need to be able to pay their expenses. So that's easy concept, right? Everybody knew that. Now you go into your income phase, you have this. Now this savings is a finite bucket at this point. It's dependent on investment gains or losses, or any fees or charges related to it, and whatever your own need is for however long. And then it becomes, because of the influence of these things, the income is inconsistent. It's not a dependable, constant pension-like income that people are looking for. And so this is what's gotten to the crisis. And a lot of people have ended up, and I have clients like this, withdrawing too much for income over shorter periods of time, and end up putting their retirement in jeopardy. So trying to help people have that perspective, I set out to do that the way it was done for my in-laws. And so to do that, one, you have to understand that. And two, you have to understand, okay, so you talk about those investment returns and how they affect you in both the income phase or in the accumulation phase and the income phase. This is integral to understand. One, first of all, it's based on something called the sequence of return. So here, very simple. You have a random set of returns in portfolio A. In portfolio B, you just take those same returns and then you reverse the order of them, flip them upside down. And now you have portfolio B, okay? Now, you superimpose the concept of sequence of returns over the concept of you being, what's the effect of those sequence of returns when you're in your accumulation phase, and what's the effect of it when you're in your income phase? This is what I find is the biggest stumbling point for the clients that I deal with. So there's just some random numbers. This is going in your accumulation. This is starting at age 45 and goes to 20 years to age 65. This randomly picks 121,000 and change to be the start number. It could be any number. If that number gets portfolio A returns, at the end of that 20 years, it ends up with 613,000 and some change. If it gets portfolio B returns, the reverse order, still ends up at the same $613,000 and change. No big deal, right? So this is what the vast majority of our clients get used to, because they were in accumulation phase for so long that they think that it doesn't matter what the market does, you know, any of those years, they're still going to end up with the same amount because that's what the effect is. What they don't realize is now they retire, they need a little over $30,000 a year from that portfolio. This is based on it being in inflation, 3%, additionally taken out a year, which is inflation's a little lower, like, you know, a little closer to 2 now, but estimates say they think maybe it'll go to 2.5 in the next 10 years. We'll see. Hopefully it won't. But anyway, this is going on 3 because it wants to be conservative. If you got portfolio A returns starting from 65 to 85, and you live to 85, you will not only have drawn out that 30,000 plus and adjusted for inflation, but you will still end up with $1.8 million. That's awesome. If you were unlucky enough to get the reverse order, you will run out of money in year 18. And that is what we're finding that people really need to understand the perspective on. They want to try to protect themselves. Anybody who, and all you folks remember 2008, during that major market correction, 53% correction, people actually realize this, right? And it's a big deal, right? So anyway, take those ideas. Now, the 4 reports that I give people, the Social Security Max report, which was always part of it. But I also give this what's called a tax clarity map report. That's just forward tax planning to tell you what your, what your tax effective tax rate will be in retirement. You can also plan around it. You can, because if you have the luxury of controlling your income amounts, you can control what your percentage is. It's a nice little tool. Take the information from your Social Security Max report, put that into this. This is a retirement planning software. Take the information from this tax forwarding report, put it into this tax forwarding software. And then the third report is from a program called Riskalyze. That basically it checks your portfolio investments for how much risk each individual one is and what the sum total of risk is for the whole portfolio. It ranks it from a 1 factor, meaning like the money's under the bed. It's the people are so conservative, to a 99, which means they're out at the casino every week with the money. So take that information. But what this does most of all, and I'll show you that, is it gives you a risk reward profile. And we're interested what the risk is. We take those numbers and the potential return and put that information into the tax planning software. And I'll show you how that plays out. First of all, here's a Social Security maximization report that I did about 2 months ago. Okay. And as you can see, based on the optimal strategy, this couple would get 181K more out. Did another one the same week, actually, and it was only 18,000 more out. But it was 18,000 more than they would have had. Here's the tax forwarding software. I don't know if you can see this, but this is the effective marginal rate in the green, 11.93. And this is before retirement. And then after retirement, the same person's effective marginal rate goes down to 3.49. This is based on 2018 rules. Okay. So then this is the risk software. That person, we analyzed, we gave them a questionnaire, or behavioral investment behavioral questionnaire, ranks them from 1 to 99 on the risk tolerance. They came in at a 33, which is about dead average of what our clients come in at. And their portfolio came in at a 47, which actually is lower than most. Most that we see coming out of 401ks and IRAs that were in accumulation phase for a long time end up being around anywhere for the high 50s, high 60s. At the end of the day, took this information. This is their portfolio. The 47 risk factor has a potential return of 5.4%. Has a 6-month 95% probability. We're only interested in the losses, okay, of a negative 8.76, because it takes about 9 to 12 months to recover from one of these corrections. If that person's income need is 50,000 or more in that period of time, then that needs to be written off as an expense, and you need to take that information and put it into the tax planning software. This type of correction happens about every 3 to 4 years, historically. So if a person's in retirement anywhere from 16 to 20 years, so life expectancy, this could happen 3, 4, 5, 6 times even. So I usually use 4 to be conservative, and then we stress test it. It shows us what a bear market, what this would look like. This portfolio, as compared to the S&P 500, would be down 18.6% versus 38%. And in a full financial crisis, like it was from October 2007 to March 2009, it would be down over 25% versus the 53%. This takes 4 to 5 years to recover from. This takes 6 to 7 years. So if that person's going to need this much money in that period of time, you need to write it off as an expense. Okay? So take that information, put it into this retirement planning software, and that person had a 71% chance of making it to their life expectancy with their current retirement plan. What that means is 71% of the time they would end up with this $480,000 at, this is saying 91. So at like 80, right around here at 700 and some, 730 or whatever it is. But 29% of the time they go bust. I usually say to people, if this was a plane and you were about to get on it and aboard it, and they said it was a 71% chance you were going to land on the other side, would you get on it? Most people laugh and they say, no, I would not. So then I usually help them, give them a little bit of guidance, show them how we can make some adjustments on that retirement plan. These people, we were able to get up to 100% chance at life expectancy, and even adjust them to have a lot more than 700,000, close to 2.4 million. So that's in a nutshell what my in-laws got to see and experience, and that's what gave them the peace of mind that they were looking for. So that all being said, that completes my presentation today. I'm sorry I took a little bit long. I had to field a few questions in the middle. My office is located in the 1015 Virginia Drive, Suite 210, in Fort Washington, PA. Not if you guys are in this in the Fort Washington or Philadelphia or greater Philadelphia area, it's about a half hour from most drives in that area. My name is Brian Dougherty. This is my email address, brian.dougherty@thrivefinancialservices.com. And my direct work line is 267-804-9708. Please, if you have any other questions or you want to take me up on getting some of those reports done for yourself, to give you that peace of mind, be happy to do it for you. Thank you for attending today. And if you have any questions, I'd be happy to answer.
Brian, I do have a few from a little earlier, and two of them might have to be offline, and I know we've run a little long, but I'll ask two of the quicker ones. What are the sources of money that are not included in the income calculation?
That's a good question. So obviously, some people, we do run into some clients that have Roth type investments, Roth 401ks, Roth IRAs. There are even Roth 403bs if you research it. If you're not in a Roth at 59 and a half, there are some people that are good candidates to do a conversion. So if you plan it correctly and successfully, it can be done, mitigating the tax situation. You can spread it out over time and whatnot. There are even some other advanced tax planning strategies that I work with some CPAs on that I'll introduce some of my clients to try to mitigate the taxes even more. But Roth is really probably the biggest one.
Okay, cool. Yeah, and I'm a big fan of the Roths as well. Is Medicare exclusive of the Social Security when claimed?
Exclusive of the Social Security when it's claimed.
When claimed.
So I'm not really sure what they mean by exclusive of Social Security. So first of all, you don't have to be taking Social Security, no, to get Medicare. They're totally independent in terms of an obligation. Well, Social Security is not an obligation, but Medicare is. The reason why Medicare is because they need to keep the fund solvent. And that's why they have such steep penalties with it, to make sure that people do. But you certainly not only could, but should file your Medicare claim regardless of when you're taking your Social Security.
Okay, great. And like I said, you might have to take these ones offline because they're probably longer answers, but are there, oops, sorry, let me scroll down. For those who have immigrated to the U.S., what ramifications for Social Security are there?
Well, I mean, are they citizens? Are they paying into the system? You know, if you're not a citizen, I don't believe you can take Social Security. So I think you have to be a citizen to take it. But if that's what they mean.
Okay. And then I'll just give you one more here. What are some examples of how you can set up things so not counted for tax purposes?
What are some examples of how you can
set up things so they're not counted for tax purposes?
So I think that's getting back to that same situation. There are, well, on a simple level, Roth is one of them, but there are other advanced strategies that people take depending on their circumstance to be able to take income in that's tax free. I mean, I don't get involved in this much, but there are some people who invest in IULs, which is a cash value life insurance product that they can take loans from, and the loans, as long as they're loans that are taken from the policy, the actual loan amount still gets credited with interest, even though it's not in the account anymore. But since it's a loan, it's not taxable. So that's another one that some people do. I have the capability of doing that. I don't get involved in it very much, but very rarely I'll see a situation if someone's younger that I might recommend that. But Roth is one of the biggest ones. Of course, meaning, you know, either recommending starting a Roth and switching from contributing to your regular IRA, your traditional IRA, or your traditional 401k at the right time, and then contribute to the Roth instead to mitigate tax. Or in some instances, it makes sense. They have Roth calculators and you can figure it out. It makes sense for some people to just do a conversion, and they'll actually make more money by converting the traditional IRA or 401k over to a Roth. As a result, when they're drawing from that in the future, it's not counting towards that provisional income calculation that the government does. And as a result, you'll pay less tax on your Social Security.
Awesome. Thanks for answering that. Well, I appreciate the time and everything, and I encourage anybody with their certain situations, you know, talk to Brian. You have his information there. If there's anything I can do to help you guys as well, let me know. Appreciate the time, though, Brian.
Absolutely.
Thanks for it.
Loved it. Thank you for having me.
You're welcome. Everyone have a great day. Bye-bye.
Bye-bye.